And joining me now to provide insight on the day's market performance is Kyle Burgess from Nedbank Private Wealth. Kyle, thanks so much for your time this afternoon. So recession fears seem to be back on the table, and that's sparking the initial market sell-off we saw at the top of the week. Overnight, U.S. stocks tumbled. Somewhat of a recovery coming through today. We are seeing some green in Europe, some green here at home, as well as in Asia. This, of course, coming as a relief. But is it sustainable, Kyle, considering that we have another risk factor coming through tomorrow with that CPI print out of the US due as well?
Yeah, certainly. Thanks very much for having me on the show. It has been a difficult time for US investors, particularly last night. I think the Nasdaq was down very close to 4%. And then we saw the S&P 500 also giving up some gains. But it's been the same story that we've seen the last 2 or 3 weeks. And in fact, since Donald Trump's come to power, we've seen all of those gains being erased in the last 3 or 4 weeks, with markets coming under a bit of pressure. So I think, if you look back at the starting point at the beginning of this year, there was a lot of optimism priced into what we could potentially see from the US economy. With Donald Trump coming into power, the Republicans sitting in the White House, perhaps a pro-growth agenda being focused on. And we've seen quite a big switch from that over the last 6 weeks. So we've seen tariffs going up and down on trading partners with the US, which is certainly playing into our recessionary fears, and certainly the economy in the US potentially not performing as well as we are as was expected perhaps 6 weeks ago. But again, there's also some conflicting comments that we're seeing out of the White House. On Sunday night, President Trump, in an interview with Fox News, he couldn't really say that the US wasn't going into a recession. I think it's a very difficult thing to forecast, firstly. But then again, earlier that week, his Commerce Secretary Howard Lutnick had, categorically said that the US wouldn't be facing a recession. So really just conflicting messages, and again, perhaps just a knock-on effect from all the uncertainty that we are seeing following the tariffs and just general US policy at the moment.
And talking about uncertainty, JP Morgan recently downgraded its position on SA equities from overweight to neutral, citing economic slowdown concerns. Do you think the change in sentiment is generally on the back of the broader downbeat sentiment we've been seeing? Because, even HSBC downgraded US equities to neutral.
Yeah, so I think, if you look at us or South African equities relative to US equities, from a valuation perspective, we've certainly looked a lot more attractive than the US has. So, the US has been trading at a very lofty multiple. You could perhaps say that, that's for reasons like US exceptionalism, earnings growth that we've seen coming through from some of the tech names. But from a South African perspective, and it's a position that we took perhaps before the elections, where we felt very constructive on SA equities. There was opportunities in the market, and although perhaps the result of the election wasn't necessarily exactly what we thought, we were on the right side of it being sort of business friendly. And that meant a nice rally in SA equities. We've seen that come through. So we're back towards close to our long-term average from a price earnings ratio perspective. So I can certainly understand perhaps not being constructive when you look at it from a GDP perspective. Certainly if you're looking at 2% GDP growth as perhaps a benchmark, and I haven't read the report myself, but I believe they're looking for sort of a 2% GDP growth. But again, I think that there are opportunities in the SA equity space, but you got to be very careful. I think, in kind of sort of, if you look at this at valuations where we are now relative to perhaps 2022 and 2020, you need to be very selective about the businesses that you're investing in. And I suppose, one of the things to look at is in the retail space. If you're a shareholder of ShopRite relative to a shareholder in Pick n Pay over the last 12 months or 2 years, your investment outcomes would have been very different, although you would have had exposure to grocery retail. And that's maybe a bit of an obvious, comparison. But, we think going forward, that's going to be, stock selection is going to be absolutely crucial in the SA space. So I can understand where they're coming from, looking for 2% growth, and off the back of the rally that we have seen in broader EM and South African equities over the last 6 months.
And it's very interesting to see the different expectations from these corporates. Here, JP Morgan is saying that they're not sure that we can reach that 2% target, but ABSA in the meantime is saying that the economy could grow by 2% this year. They're also out with results this afternoon. Earnings there jumping about 10% and really on par with its competitors, because when I think of First Rand's earnings, when I think of Nedbank's earnings as well last week, I think they were also up about 10%. What have you made of those numbers in particular, Kyle?
So I think to answer your first question, I think you need to be very careful and selective about the economic forecasts that you choose to follow or choose to listen to.
Okay.
And then more importantly, I think you need to be invested in businesses, particularly like the banks. And ABSA is a good example of that. Nedbank's a good example of that, where we've been operating in an environment, or these businesses have been operating in an environment that's very difficult. The consumer has been under pressure, but again, still managed to eke out revenue growth and headline earnings growth of very close to 10% in the case of ABSA, and they, distributing quite a nice portion of that to shareholders in the form of dividends. So yeah, I think that there's certainly opportunities in that space, and quite a nice set of numbers that were released from ABSA. I think what probably disappointed investors was the ROE number that came through, probably a bit weaker than its peers. But again, that arguably is factored into the price. You're paying 7.5 times roughly earnings for this business, and they're producing 24 odd rand in earnings, and I think paying you around 13 rand in dividends. So yeah, pretty good prospect, and I think the market quite like that. The share up about 1% at one point today.
Markets also liked tax numbers. They've delivered a near 50% jump in distributable income. Quite a lot of corporate action taking place in that company over the past year or so. The disposal of its mass stake, shifting its focus solely on SA assets, and acquiring that additional stake in Mall of Africa, making it the sole owner of the mall. Your reading on those numbers and just the state of its balance sheet?
Yeah, so I think, just perhaps to start with your last question, the balance sheet sort of gearing went up marginally over the last 6 months. So I don't think investors would be too concerned about that. It's still only at about 25%. But again, if you look at a tech, more of a development play than a sort of a retail office, traditional type of property play that you do see on the JSE. So yeah, a great set of numbers. And I mean, again, if you have a look at the share price, it's performed very well over the last 2 or 3 months, up, I think, about 25% in quite a short time period. So a pretty good set of numbers. You mentioned there's quite a lot going on from a corporate perspective. And I think one of the interesting things about that is just their data and warehousing or their data center exposure. I think they're one of the very few corporates in South Africa that give you, or property counters in South Africa that give you exposure to data centers, and that's in Waterfall. So yeah, interesting set of numbers to comb through, and I think investors should be quite pleased with it.
All right, Carl, let's just hit pause on the conversation. Before we get to your stock pick, let's reflect on some counters that have found favor with your industry peers.
Diageo, obviously global spirits business, a giant in anybody's books, great portfolio. LATAM hurt them, and I think more recently, again, tariff threats have come down, so have caused them to come down. So my sense is that under £22, forecasts are for about $1.70 to maybe $1.75 on a 1 year rolling forward. Those multiples are right for a business that is, I believe, fundamentally defensive, but they're doing enough in that portfolio to actually sustain earnings growth. So the forecasts are fairly muted in terms of earnings growth, but I think you're buying a fantastic business that's largely defensive on a low multiple and a dividend yield, if memory serves, of about 4%. So okay. I'd rather be there than sitting in a long dated treasury.
Yeah, as Graham mentioned the defensivity, or the defensiveness of Diageo. The other sector that's also defensive in these uncertain times, strangely enough, is health. And that's normally because you're sitting with pharma companies doing a lot of R&D and getting wonderful products, and it's sort of that kind of profit is divorced from what's happening in the general economy. Yeah. But within health, there's also something called medical devices, and Medtronic is a company that operates in that field, has been doing so very successfully, and that also involves a lot of R&D. As I said, they've been very successful. They've had 47 years worth of uninterrupted dividend growth. They know what they're doing. And certainly in their very specialized fields, in terms of robot surgery, artificial intelligence, being applied to endoscopy, for example, some of their products. It's a hugely exciting business in terms of what's happening with robotics. And AI price has been flat for almost 2 years, down a forward P of about 18, upside from current about $97 to 110 or 115. Defensive and possibility of a share price increase.
So Medtronic and Diageo, your views on those counters, Kyle?
So Graham makes quite a compelling case for Diageo, and I mean it's a business that's got operations in 180 different countries. They've got some phenomenal brands in their portfolio, like Johnny Walker. I guess my concern with Diageo specifically would revolve around two things. I don't think it's necessarily super cheap at 17 or 18 times earnings. And then if you have a look at the global sort of liquor market at the moment, I'd certainly prefer to be invested in something like Anheuser, which dovetails, I guess, quite nicely with my stock pick, but a business that is quite easily able to tap into non-alcoholic beverages or zero alcohol ready-to-drink beverages. I think if you have a look at the general demographics, your baby boomers are typically your sort of heaviest drinkers. They drink quite regularly and fairly heavily. But as you go down that sort of generational sort of scale, you are looking at younger generations drinking far less. So you need to sort of expand your categories. And I think it's, while they do have, things like Smirnoff, which they could, I guess, make a zero alcohol drink from, I'd certainly prefer to be, in a place where you could potentially expand that category. I think it'd be quite difficult to perhaps look at a Johnny Walker zero alcohol. But again, these are phenomenal businesses that have been around for many, many years and have a very strong following. So I can certainly understand being invested in Diageo. And then with regards to Medtronics, it's not a business I know a huge amount about.
Okay.
But if we have a look at just general healthcare, I think as an investment theme, it's been quite a tricky one because it is quite defensive. If you look at hospital stocks in SA specifically, what we have seen is those surgical or elective surgeries, particularly in something like Life Healthcare or Netcare as an example, they haven't really recovered as quickly as they'd like to, or as healthcare executives or investors would have liked to have seen perhaps post-COVID. So that's perhaps one thing to take into consideration. But again, they do some incredible work in terms of what they're trying to achieve from a patient outcomes perspective. So certainly an interesting sector to look at.
All right, let's get into your stock pick quickly. You did mention that it's AB InBev. We have about 30 seconds, so you can state your case on that.
All right, I'll try and keep it fairly brief. But again, you've got a business here that's taken on a huge amount of debt back in 2015. They acquired SAB, and they've got a wonderful portfolio of different brands. And I think importantly, they've been able to pay down that debt very aggressively over the last 10 years. We now see the business sitting at 2.5 times net debt to EBITDA. So there's a bit more leeway for management to perhaps increase dividends, make acquisitions, or just generally increase shareholder returns. And again, they've proved very good at deploying capital in the various different markets where they operate, and being able to expand those categories. So at least 21 times earnings or 20 times earnings, not the cheapest around, but if you can grow at 6 or 7 times, or if you can grow EBITDA at 6 or 7 times, it's a business that we feel you'd want to be invested in.
All right, so AB InBev, one to look out for. Kyle, thanks so much for your time and taking us through the market's activity. That was Kyle Burgess from Nedbank Private Wealth.